Are you holding too much cash in your portfolio? Do you want to make the most of the market opportunities in 2024? If so, you need to hear this urgent message from a top strategist. Get out of cash now. Why? How? What are the risks and rewards? Come, let's find out more. A market strategist has issued a warning to investors, suggesting that they should get out of cash now. This means that the strategist is advising investors to invest their money rather than keeping it in cash. The reason behind this advice is related to the current economic conditions. As we head into 2024, inflation, which is the rate at which the general level of prices for goods and services is rising, seems to be cooling down. This means that the cost of living is not increasing as rapidly as it was before. At the same time, the market, which includes all the places where stocks, bonds, or other securities are bought and sold, is beginning to recover. This means that the value of these investments is starting to increase. The Federal Reserve, which is the central bank of the United States, has signaled that it will maintain higher interest rates for a longer period. Interest rates are the cost of borrowing money. When interest rates are high, it costs more to borrow money, and it also means that you can earn more on the money you have saved or invested. Because of these conditions, the strategy of keeping money in cash may be outdated. When you keep your money in cash, it doesn't earn interest. So if the cost of living is increasing, even if it's increasing slowly, and if you can earn more by investing your money, then keeping your money in cash could mean that you're losing out. However, it's important to note that investing always comes with risks. The value of investments can go down as well as up. So, while the strategist's advice might make sense in the current economic conditions, it's always a good idea to consider your financial situation and goals before making investment decisions. Last year, many investors preferred cash over other assets due to the unstable and unpredictable market conditions and the rising cost of borrowing. However, as we enter 2024, the situation seems to be changing. The inflation rate is slowing down, and the market is showing signs of improvement. The Federal Reserve has indicated that it will keep the interest rate high for a longer period, which may make cash less attractive. Gargi Chaudhuri, the head of investment strategy for BlackRock America's iShares, talks to Yahoo Finance about the current state of the market and what investors should think about for 2024. Chaudhuri shared her opinion for the near future. She said that Chair Powell will probably say that it is too early to discuss lowering the interest rate. However, this has implications for investors because historically they have performed well in the rate pause period, which is the time between 6 months before and 6 months after the first rate cut. Chaudhuri said that investing in this period is very important, regardless of whether you are in the bond or equity markets. Investors don't expect the Fed to go this week. They believe that the July hike was the last one, which means that they're now going to just leave rates on hold for some time and just see how the economy evolves. Those factors will really determine which companies and which sectors of the market continue to do well. So, looking at something like the quality ticker, looking at large cap growth like IBY, looking at ways in which they can even take advantage of some of what they call the lovable laggards, some of the areas that haven't done as well. Healthcare is top of mind there, where obviously not a great year in 2023, but still quality, and they have that earnings growth that's going to come in 2024. And that's what they think investors should focus on for at least the first couple of months of 2024. Keeping quality in mind as they move away from this very resilient growth picture to a slowing growth picture in the first quarter of 2024. The reason why the strategist says this is because she expects the market to perform well in 2024, meaning that the prices of stocks and other assets will rise and offer higher returns than cash. The strategist bases this expectation on several factors, such as the inflation rate, which is the measure of how much the prices of goods and services increase over time, is expected to slow down in 2024 after reaching high levels in 2023. This means that the purchasing power of cash will not decline as fast as before, and that the cost of living will be more stable. The interest rate, which is the amount of money that banks charge for lending or saving, is expected to decrease in 2024 after the Federal Reserve, which is the central bank of the United States, raises it several times in 2023. This means that borrowing money will be cheaper, and saving money will be less rewarding, which will encourage more spending and investing in the economy. Economic growth, which is the measure of how much the total output of goods and services increases over time, is expected to recover in 2024 after a mild recession in 2023. This means that the demand for goods and services will increase, and that the profits and revenues of companies will improve, which will boost their share prices and dividends. The market sentiment, which is the overall mood and attitude of investors toward the market, is expected to improve in 2024 after a period of volatility and uncertainty in 2023. This means that investors will be more confident and optimistic about the prospects of the market, and that they will be more willing to take risks and buy more stocks and other assets. Therefore, the strategist believes that holding cash in 2024 will be a missed opportunity, as cash will not grow in value as much as other assets, and that investors should get out of cash now and buy other assets before their prices go up. This is the main message of the market warning. Conditions in the global market in 2023 were quite dynamic and varied across different regions. Overall, the global economy was projected to grow by 1.7% in 2023 and 2.7% in 2024. However, this growth was expected to be widespread, with forecasts in 2023 revised down for 95% of advanced economies and nearly 70% of emerging market and developing economies. In terms of economic outlook, there was a more even split between optimism and pessimism. Respondents were hopeful about their country's economies, though sentiments varied significantly by region. In Europe, where respondents were most concerned about the effects of inflation, expectations for the next 6 months turned more negative, whereas respondents in North America offered increasingly brighter views. Geopolitical instability and inflation remained two of the most frequently cited risks to the global economy. Respondents, particularly in Asia-Pacific, were closely watching China's economic activity. Overall, concerns for those risks superseded the perceived threat of rising interest rates. The World Bank slashed its 2023 global economy growth outlook to 1.7% for 2023, from its earlier projection of 3%. It would mark the third weakest pace of growth in nearly 3 decades, overshadowed only by the global recessions caused by the pandemic and the global financial crisis. You've been saving cash for a rainy day, but what if that day never comes? What if the market is about to soar in 2024 and you miss out on the chance of a lifetime? Get out of cash now or regret it later. Comment your thoughts on this and don't forget to like, share, and subscribe.